Hey, welcome to this week's video. Rental properties can be a great source of income and possibly help reduce your taxable income. Actually, this is probably one of the top tax strategies used by many real estate investors and the rich as well. Why? Well, because rental properties can produce a tax loss while still generating positive cash flow. Magic? Well, maybe, but it is definitely possible. The challenge is there are a lot of rules you need to make sure you follow. So in this video, I'll explain what this means for you and how you can use your rental properties to shelter some of your income and to save big on taxes. So let's get to work. So first, why is this important? Well, there are two types of income. One is called passive, and the other is called non-passive. Passive income generally is income you earn, but you don't trade your time for that income. So passive income comes from things like investments that you don't participate that much in, like stocks, crypto investments, and possibly rental properties you own. Where non-passive is basically the opposite, where you trade your time for income, such as W-2 job or a business that you run, and possibly that rental property you own. What focus on is passive and non-passive income related to rental properties. So you might be asking, what's the big deal here? Well, let me explain by giving you an example. Let's say you have W-2 income of 175,000 and a paper loss on your rental property of 15,000. That was generated from depreciating your rental property, but you actually generated positive cash flow from the property. If your rental property is treated as a passive activity, you would not be able to deduct that 15,000 and offset it with your 175,000 in income. Worse yet, if your rental property is considered a passive activity, that loss generated by your rental property can only be used to offset future passive income and will stay trapped as a non-usable loss until such things like that you sell your property. However, if you could treat that rental property as non-passive, then you possibly could offset that $15,000 loss against the $175,000 income and generate a tax savings of possibly $3,000. So you see, your property classified as a non-passive activity could save you big money in taxes in addition to positive cash flow you generated from your rental property. But there is a big hurdle to jump over to get your property classified as non-passive, which we will discuss next. So first, your rental property will be considered a passive activity unless you can prove otherwise and make this known in your tax return. To qualify your rental property as a non-passive activity, you basically have to pass two tests. The first test is the individual hours test. Here you are looking to prove that you spent more than 750 hours in real estate industry, such as a developer or an agent or another qualified activity in the industry. Basically, your primary work needs to be in the real estate industry, but you don't need to be a licensed real estate agent to qualify. The next test that you need to meet in addition to the hours test is the material participation in your rental property. So the IRS states that to meet this test, you basically have to either work at least 500 hours in the business, or did nearly all of the work, or work more than 100 hours and no one else worked more than this, or materially participated in any of the 5 out of the 10 years. The good news with this test, unlike the last test, is that you can combine your hours with your spouse and you can do other things like combine the properties. In other words, the last test was an individual test, but this test allows you to combine with your spouse and do some other things. Again, there is a lot involved in this test, so check with your tax professional to make sure you meet this test and have documentations to prove this. Keep a record of your hours, for example. There is, however, an exception to being able to take your passive losses against your non-passive income if you do not meet the rules I previously mentioned. That is, if your income is less than 100,000 or between 100,000 and 150,000, then you could possibly take up to 25,000 of your passive loss against your non-passive income. Also, one strategy I see that if one spouse doesn't work or does work and is focused in the real estate industry, but the other spouse isn't, then one spouse qualifies for the individual hours test, and both spouses combined qualify for the material participation test. The key again is to document this should you ever be challenged by the IRS. Now let's talk about another exception to be aware of, and that's called the self-rental rules. Basically, I have a lot of clients that purchase a building and then rent the building to their business. Well, this causes issues with the material participation test that we discussed earlier because your rental property is rented to a related party, which is you. So if the entity that you are renting the property to is an S corporation, LLC, or sole proprietorship, in other words, not a C corp, you could possibly make an election in your tax return to combine the rental property as or with the business for purposes of material participation tests. See, I told you these rules are complex, and again, always check with your tax professional as well on this one, as this is actually a special election you need to make in your tax return. Okay, last one before we get to the good stuff, the top 5 deductions. Another exception is the vacation home rules. I won't get into this one that much, but if you end up using your rental property more than 14 days or more than 10% of the days you rented it, you might have to treat that property different for taxes and be stuck with passive activity rules and limits on the rental property losses and possibly allocation of costs. Whew, let's finally get into some of the deduction benefits of owning a rental property. First is the benefit of being able to do a 1031 exchange. Here you're basically selling your business property, not your personal property, and exchange it for a qualifying property and defer any gain you might have made from the sale of your property. The advantage is that you could avoid all or most of your capital gain and avoid paying taxes on the sale. In fact, if you could do a 1031 exchange for the rest of your life, and then upon your death, the property goes to your heirs, you and your heirs could avoid paying any taxes up to the point on gains from the sale of that property up to the point of your death. So for example, if you buy a property for $500,000 in 1984, and you did 4 1031 exchanges after that, your initial purchase price, you deferred paying any taxes on that gain up to this point. So let's say you depart this planet in 2050 and the property is worth 4 million for a gain of 3.5 million, which could be a tax savings of almost 700,000 if you followed the 1031 exchanges. Depending on when you're watching this video, check on the rules as it has been attempted a few times to take away this benefit. So benefit number 2 is the deduction of your home office. If you use a home office for purpose of your rental property, you might be able to deduct some of your home costs such as property tax, insurance, utilities, rent, and even cleaning. This deduction is based on actual cost and allocating a portion of indirect costs such as electricity. It's based on your office space to the total space of your office. Also, you don't need to own a home to take advantage of this deduction. Deduction benefit number 3 relates to how it is possible to generate a tax loss but still generate positive cash flow from your rental property. Basically, the IRS allows you to deduct certain cost of your rental activity over time through a method that's called depreciation. Items that are required to be depreciated include such things as the building itself, certain repairs that add value to your property, such as a renovation, and other things such as equipment. The one thing to be aware of is that land is not considered an asset that you can depreciate and expense. I think of depreciation as taking a deduction now, but having to pay for it possibly later when the property is sold, as depreciation reduces the basis of your property, thereby creating a bigger gain when you sell it. When you purchase a property, you acquire more than just a structure. You gain a set of the building components. While you might look at this as one piece of property, 20 to 40% of the building consists of parts and pieces that are put together, and it may be looked at differently by the IRS. So why is this important? Buildings are normally depreciated over 39 years or 27 and a half years for residential. If the value of the building you purchased is, say, 300K, then you would depreciate this over 39 or 27 and a half years, which is a long time. But if you could take that 300,000 and break it into categories of assets that the IRS allows you to depreciate over a shorter period of time, such as 5, 7, or 15 years, you can see that you could accelerate some of that 300,000 and deduct more, at least in the beginning of owning the property. The idea of deduction benefit number 4, cost segregation, is to allocate each of your property related costs into their appropriate property class in order to better calculate depreciation deductions and put them into a shorter period of time if you can. This gives you a bigger deduction in the earlier years and tax savings. Typically, you hire an outside company that specializes in doing cost segregations. But benefit number 5 relates to deducting your travel expenses related to your property. The travel needs to be outside of your main tax home area, but you can possibly deduct things such as lodging, meals, and essentials, and have others tag along, thereby possibly combining some of your vacation and business travel expenses and deducting some of your vacation expenses. So, some other deductions you could possibly take for your rental property include costs such as professional fees, property management costs, independent contractors, interest, taxes, repairs. But remember, some repairs could be considered a asset that would need to be depreciated over time. The key is to make sure you are doing accurate bookkeeping to make sure you deduct all the costs you're entitled to deduct and able to provide documentation should you ever be questioned by the IRS. So some key takeaways here is that real estate can be an effective tax shelter. But the rules are tricky, so you want to make sure that you check with your tax professional to understand the rules and make sure that you're compliant and that you're actually recording it correctly and reporting it correctly in your tax returns. And remember the self-rental rules, for example, that I talked about earlier. Well, that's it for this week's video. If you got any value out of it, it'd be great if you hit that thumbs up as it helps me out quite a bit. And if you're not a subscriber, it'd be great to have you as a subscriber. Until next time, I'll catch you on the next one.